I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a five-time published author. He wrote this book with James Turk called The Money Bubble. I'm probably giving it away here. He has a very popular website, dollarcollapse.com. I'm talking about John Rubino. John Rubino, thanks for joining us today on USAWatchdog.com.
Hey, Greg. Thanks for having me on.
Before we go on, this is one of 5 books that you've written, The Money Bubble. You wrote this about 4 years ago. It's released just right at the end of 2013 and beginning of 2014. But, wow, what you talked about in this book, The Money Bubble, I mean, you could have written it you could be releasing it this week. You have emerging markets blowing up. You have, gold and silver climbing in foreign currencies, not in the United States. Then I want to talk about that. People in the United States, this is USA Watchdog, it's USA centric, but we do have a lot of foreign people watching it. And over here, wow, gold's at 11, high 11s, 11.95. Over there, gold is skyrocketing in their currencies. What's going on?
That's the function of gold and silver, is to protect you against government mismanagement of your currencies. And the emerging market countries have, in a lot of cases, screwed up their money. They borrowed a lot of U.S. dollars at low interest rates when the dollar was falling, and then they expected to have the dollar keep falling and to pay back their loans in ever cheaper dollars. But the dollar went the other way, and so now their loans are unpayable, their currencies are blowing up, and you're seeing gold and silver rise in local currency terms. In other words, precious metals are protecting the citizens of those countries against financial mismanagement. So that's exactly what you want precious metals to do. The fact that it hasn't worked very well in the U.S. in the last few years is a shame. It's been really brutal and both boring and dispiriting for gold bugs since maybe 2012. But it's coming. We're making the same mistakes that these other countries have made in the recent past, in the sense that we're borrowing way too much money. We're leveraging ourselves in all kinds of dangerous ways. And the only way out of something like that is to devalue your currency. So we'll do it via inflation, or we'll do it via some surprise monetary reset some Friday night. But one way or another, we have to dramatically lower the value of the dollar, and gold and silver will go up dramatically in dollar terms when that happens. So long-suffering precious metals buyers will be vindicated and be relatively rich when that happens. And so now it's a question of when. It's not a question of if anymore, based on the numbers, but when this is going to blow up.
But this is blowing up in the sequence that you laid out in the book here, is it not? I mean, it doesn't blow up from the middle out. It blows up from the out in. And so the United States is going to be the big closing act, is it not? The big crescendo.
Yeah, financial crises frequently start at the periphery, in asset classes or places that you don't think of as being all that important in the scheme of things. And they start blowing up, and that causes other dominoes to fall, and eventually the crisis works its way all the way to the middle, which is what happened, for instance, after the housing bubble burst in 2006, 2007. It was just subprime mortgages to begin with, which is not really a big deal. But eventually it became a near-death experience for the entire global banking system. And since that time, instead of getting our financial houses in order around the world, we basically just kept on borrowing money. Now we've got almost twice as much debt globally as we had at the beginning of that debt-driven global financial crisis. So you can expect the next one, when it comes, to be bigger and scarier and more dangerous. There are a lot of reasons to believe that we're getting close. And one of those reasons is that the emerging markets are starting to blow up. Originally, there was just Venezuela. It was a single emerging market country that was having trouble, and everybody expects a Latin American country to blow up every once in a while. But then Venezuela was joined by Argentina, which was then joined by Turkey, which are now being joined by Pakistan and possibly Brazil. That's a lot of emerging market countries. So it's a full-fledged crisis now. And the question is, does that lead to, for instance, the big Western banks that lent all the money to these countries that can't pay their bills anymore? Does that lead to a crisis for the big banks? A lot of those banks are European. So let's say the Italian banking system is pushed over the edge, or the Spanish banking system, by the emerging market crisis. And that leads to a euro crisis in which the European Central Bank has to bail out these big systemically crucial banks by creating a lot of new currency, which makes the value of the euro go down, and then things start to spin out of control there. And then it works its way to the US, because a soaring dollar versus the euro is really bad for us in a lot of different ways. And we could be seeing that, which would then be a precursor to the Fed having to bail everybody out and the dollar plunging. So that's the kind of scenario that we're at the early stages of. And there's no guarantee that it progresses in exactly that way, but that's a very reasonable scenario, and it could happen in just a few years. Once these things get going, they tend to accelerate. So what seems like a long-term process turns into a few months of stock markets crashing and governments defaulting and on, until you've got a global crisis. So that's what will probably happen in the next few years, and we should really be prepared for it.
It might happen in a few months. I mean, Turkey's they're saying they're not going to have capital controls, but they are. Everybody's going to have capital. Everybody's going to try to keep their money from running out of the country. I mean, this could turn ugly a lot faster than a few years, could it not? Yeah,
well, Turkey's predicted by a lot of people to default on their debts pretty soon. And they owe a lot of US dollar external debt, which means, see, when you owe something, somebody lent it to you, right? That means some banks lent a ton of money to Turkey. So that's really the thing to watch now. If Turkey can't save its currency and they end up defaulting on their external dollar-denominated debt, who is hurt by that? And if somebody like a big bank like Deutsche Bank or Citigroup or whoever it is that is on the hook for this is impaired by this, then who's hurt by that? So we follow the chain of injury when there's a financial crisis somewhere and see where it leads. And in this case, it leads to the core. So let Turkey fail, and then everybody's looking around for the next crisis in the emerging markets. They all pull back from lending money to let's say, Brazil. And then Brazil has trouble. And then all the banks that lend money to Brazil, that's how it goes. And we'll see how long it takes. It can happen slowly. I was a junk bond analyst back in the late 1980s. And that crisis seemed to drag on. It was years of people saying, well, the market's going to collapse. The market's going to collapse. And finally it collapsed. The housing bubble was much quicker. It blew up, and then it took everything down with it in a year or two. So there's no way to know how this goes. But we've created the conditions for another one of these big bubbles bursting. And historically, the way you protect yourself from stuff like that is to short financial assets and go long precious metals. And that's been the play that I've been recommending for a few years, and it's been wrong for a few years. But I think it'll be vindicated in the not too distant future based on what's happening in the world now.
Well, I mean, this is kind of like the Puerto Rican thing. If you take a look at it, smaller, it's not a country, but it kind of is. It's a territory of the United States. They had $74 billion in bond debt, and just knocked up many months ago. Donald Trump, I heard him quoted as saying that, we're going to let that go. We're going to let that go. So if everybody thinks that they're going to liquefy this stuff, I mean, that's deflation. That's debt destruction. And I think if you're looking at okay, we can make Puerto Rico got down to we can make our payments or we can not pick up the trash in the streets. What did they do? They picked up the trash in the streets. They fed people. They didn't make the bondholders sorry, we can't pay. I mean, this could happen in Brazil. This could happen in Turkey. This could happen in Pakistan. This could happen in all over. Most of the countries in the world are emerging markets.
Yeah, it could spread from here because a lot of emerging market countries have borrowed a lot of US dollars. And that's the thing that's killing them right now. As the dollar gets stronger, it's harder to pay off their debts. And once one of these countries gets into trouble, people are less likely to refinance the debt of the others. So you get a big crisis at the periphery. And that's kind of what we've got now. Puerto Rico was one place. Now we've got 5 or 6 countries, all of which are bigger than Puerto Rico, in kind of the same boat where they're bordering on defaulting on their debt, and they're heading that way. So the question becomes, what is the consequence of that. And historically, like I said, a really big crisis on the periphery eventually affects the center, the core of the economy. And the U.S. is at the core of the global economy, so we would probably be last to go, but when we go, it'll be a big deal.
Let's talk about your article. You also write a lot of articles on dollarcollapse.com, which I think is a smart thing. You're writing more now than ever. I mean, you're a 5-time published author. This is your book. It's still you can still get this book. I'll put a link to it at the end after the interview section. The Money Bubble. It could have been written this week. I'm telling you, it could have been written this week. But anyway, you wrote an article about with the price of gold in dollars being down. The price of silver, it's 15 and change. It's like we're approaching mining costs for both. But yeah, you say you look 6 months into the future in your most recent article, and you say gold is good and silver is really good. Why?
Yeah, well, there are a couple of indicators that have historically been pretty good predictors of 6 or so month moves in gold and silver. One of them is the Commitment of Traders report. That's a snapshot of what the players in the gold futures contract market are doing. There are speculators in that market who trade on emotion and momentum, who, because of that, tend to be wrong at big turning points. Whenever they're extremely bullish or extremely bearish, the market tends to do the opposite. They were really, really bullish earlier this year, and the gold market has just ground lower month after month, and it's flushed out a lot of the speculators. They've gone progressively more short, until right now they're almost net short. In other words, their shorts exceed their longs, and that's really unusual for them. And historically, it precedes a big increase in gold and silver's price. So we're seeing that right now. And with the action this last week, we'll probably see it again in the next Commitment of Traders report that's released on Friday. So that's an indicator that if history is still any kind of a guide, says the gold and silver ought to go up for the next few months, maybe the next 6 months. And meanwhile, there's seasonality. The biggest buyers of precious metals in the world are Indians and Chinese people and their governments. And they tend to do most of their buying in August through February. So we're heading into a time now where they haven't been buying much gold and silver through the summer, but they're going to start again. So you've got these two things combining right now, with the speculators flushed out of the market and probably ready to jump back in when gold and silver start going up, and the Indians and Chinese beginning their seasonal buying. So combine those two things, and you've got a pretty good chance, based on historical precedent, of a 6 month time frame that's way better than the last 6 months. Now, as for why silver is better than gold, to put it simply, it's pretty rare, and it's a tiny market. There's less and less silver available out there every year because it's, besides being a monetary metal, it's an industrial metal. We put it in solar panels and microchips, and a lot of that's not recycled, so the silver just disappears. So above ground silver stockpiles have been declining for the last like 30 or 40 years now, and they're minuscule. Meanwhile, we produce about 10 times as much new silver, we mine it, as we mine gold. But the price of silver is about 1/78th of the price of gold. In other words, it takes 78 ounces of silver to buy an ounce of gold. So when things really get going, we should expect to see silver go up more than gold to compensate for the fact that it's unusually cheap relative to gold. So you could see silver trend back to 30 times or 1/30th the price of gold, which means it would go up twice as fast as gold in a bull market. And that means the junior silver miners are the dot-coms of this coming cycle. If it plays out that way, you'll see these little mining stocks that have very thin floats and very minimal institutional following just rocket. So that's if you're an aggressive investor right now, junior gold and especially silver miners would be the place to be, I think.
Or you could just make it the easy play and go buy yourself a monster box of Silver Eagles. I mean, you just go buy yourself a roll of silver. I mean, it just dollar cost average silver. It's near mining cost. There's not a lot of load to it, especially if we have one of these big, fast moving. Once Turkey stops paying their debt, I can't imagine everybody else is going to go, well, I'm going to pay mine. Or they say, well, if they're not paying theirs, I'm not going to pay mine. We're not going to have a hardship on our people just to pay bondholders. I mean, that's what they did in Puerto Rico. Then that's the metric there. I mean, you got to see people stop paying their debts in a hurry, don't you think?
Yeah.
I mean, that's deflation, right? I mean, that's debt destruction.
That's usually how it works, and it's extremely deflationary. But what's inflationary is the response of central banks to something like that. Because there's so much debt in the world, they can't allow any big players to default, because that would push so many other big players into default that you'd see a kind of a cascade failure of the leveraged speculating community out there, and that would be the end of the financial system. So what central banks will do is what they did in 2007, 2008. They'll jump back in and bail everybody out in sight and create as much new currency as it takes to cover all these debts, and that will impact the value of these fiat currencies. There's a concept in the Austrian School of Economics called the crack-up boom, which is the point at which everybody finally figures out that it's the explicit policy of their government to make their currency worth less year after year after year, and they don't want to hold the currency anymore. So as soon as they get paid, they turn that money into real stuff. And so you see the price of real things spike because everybody's buying real stuff at whatever price they have to pay. And that manifests as accelerating inflation, but what it really is a loss of faith in the currency. And I think that's the end game of this system, where the central banks and central governments are bailing out so many different players with so much new currency that people finally figure out that that's a bad deal for the holders of that currency. And they start front-running the process, and the system breaks down. So this could be the time that it happens, because the amount of debt that would have to be bailed out by the world's central banks is immense. It's much bigger than the bailouts that we had to do, or that we perceived we had to do, in 2006, 2007, 2008. And that was multi-trillions of dollars. So this time, the central banks are going to say, well, okay, if $10 trillion didn't do it, let's do $20 trillion, whatever it takes, whatever we have to do. And the numbers will be so immense that there's a decent chance that people figure it out, see it for what it is, which is the systematic destruction of these fiat currencies. And then, Greg, all hell breaks loose. The system that depends now on our faith in the people who are managing the fiat currencies will evaporate. And the currencies will evaporate along with them. I know that sounds crazy, especially in this world of a
not if you're in Venezuela.
Dollar. Yeah,
not if
exactly.
you're in Turkey. Not if you're in Argentina.
Yeah.
Right?
Yeah. It sounds crazy to Americans, but if you look around the world, that exact thing is happening in several countries, and apparently coming to several more countries. And it's heading our way. So yeah, it's a terrifying prospect, but it's also exciting because this is an investment thesis. In 2008, 2009, if you saw the movie The Big Short or read the book, you know that the financial crisis brought with it a lot of opportunities. In that case, it was shorting the housing market, and the people who did it right, timed it well, and stuck with it, ended up making huge multiples of the capital that they put into it.
Dr. Michael Burry.
Yes, and John Paulson made $20 billion on that one play for his hedge fund.
Wow.
So there are things like that coming again. When I throw out all this crazy sounding gloom and doom stuff, what I'm really saying is, okay, there are amazing opportunities coming our way. If we play this right, if we position ourselves correctly, we can at least protect ourselves. And we can very possibly make life-changing money. That's what those guys did, in the time of The Big Short. They and a lot of other people. So something like that is coming again, and the question is, what should we do this time around? The people who own gold and silver in Venezuela, for instance, are pretty happy right now. They made the right choice.
Oh my gosh, they can buy farms, they can buy buildings, they're the only. I mean, you don't have to be that clever. You don't have to have some clever investment thesis. Just for normal people, just buy real stuff. Make sure you pay off your real stuff and keep buying real stuff. And that could be a car title. That could be your house. That could be gold, silver, food, water. That could be, a functioning business that you could pay cash for that has a cash flow. I mean, right?
That's exactly right. The basic thing to do is shift your finances out of dependence on fiat currencies. In other words, if you have government bonds or a bank account or a money market fund, those things depend on the value of your currency. And if the currency goes down, especially if the government, explicitly starts pushing it down and everybody starts front running, then your bank account gets less valuable, your money market fund gets less valuable, your government bonds tank, and you lose. But if you own real stuff that governments can't just make more of by typing in some numbers and clicking send, those things will tend to go up in value as the currency goes down, and your finances are protected in that way. Historically, precious metals have been the thing that did best, but good farmland, a well-chosen real rental property, some energy assets like high-quality oil stocks or something, at least for the cycle to come before solar power eliminates oil. But those are the things that will protect you, and those aren't hard things to do. Most people understand everything I just said. They don't have to be shorting exotic derivatives the way the big short guys did. But the big short guys didn't have to do that either. All they had to do was short bank and home builder stocks. And that's something that is sort of intermediate, right? That's a little bit sophisticated for the average investor, but not that conceptually different from buying a stock. If you're shorting something, you just sell it before you buy it.
Right.
Yeah, it's doable.
You talked about the reset, and and I don't want to gloss over this because they know this is happening. Steve Mnuchin knows this is happening. He's not a dumbass. The people who are running the European Central Bank, they know this is happening, even though they act like they're surprised and, we didn't know that was happening. They know this is happening. They're not stupid. They got tons of PhD economists. They know there's going to be a reset. Could you describe what you think that would look like? Because they don't want to run this over the cliff and be, Thelma and Louise. They're going to stop before the cliff. They're going to do something. They're going to fly their airplane into the mountain. Tell me what a reset looks like.
Yeah, see, that's one of the hopeful things about our situation is that the people who own an awful lot of government bonds and an awful lot of cash and awful lot of money market funds are the ones who get this and who have a chance to stop it before it turns into some kind of geopolitical nightmare. They can stop it by some Sunday night, just announcing that the dollar is going to be devalued by 50%, let's say, and henceforth, it's basically just going to be a name for a weight of gold. So we go back to the classical gold standard. That's one way to do it. There are other ways, but I'll stick with this as an example because I think it would be the best way. And you get this burst of inflation. If the dollar's been devalued to, say, 1/10,000th of an ounce of gold, then milk is way more expensive on Monday morning, and bread and cars and everything you're going to buy is way more expensive. But going forward, the government can only create as many new dollars as it acquires new gold. And that's like 1 or 2% a year. Okay, so the money supply is constrained going forward, and you have what is, quote unquote, sound money. Money that will hold its value over time because it stays fairly rare. It only increases in supply at about the rate of population growth. So you're in a system that is, from that point forward, sound again. You can't run up insane amounts of debt and otherwise abuse the financial system. Now, if you have government bonds and a bank account and a bunch of cash, you're hurt by that because all of those things become less valuable. Yep. But if you own a bunch of real stuff, you benefit from that inflation because the price of all the real stuff you own has gone up as the dollar has gone down. So that's the scenario that is both simplest, least violent, and easiest for people who are thinking about buying gold or silver or other real assets to understand. I'm not saying it's the most likely because democracies usually need a crisis before they take big action. And in this case, the action involves government giving up a lot of power and the big banks giving up a lot of power. So they won't do that lightly, but it's easy to see a scenario in which they come to view it as the least bad option from their point of view. Because, you've got French Revolution type scenarios out there that really aren't that far-fetched, where people just rise up against the 1% and start doing really bad, scary, irrational things that are beyond the control of the 1%. They don't want that to happen. As a quick aside, someone published an article just lately who the guy is a a business and technology consultant, and he spoke before a bunch of billionaires, thinking that they would want kind of nuts and bolts, how to build your business, how to invest kinds of things. They wanted to talk about how to deal with Mad Max scenarios. They were all building their bunkers in New Zealand, and they wanted to know things related to that. You know, how do you manage crowd control, and how do you survive for 2 years without basic services, stuff like that. These billionaires were asking that kind of question of this guy, and he was amazed by it because he didn't expect it. But that's actually where a lot of these guys are right now. You know, they've accumulated insane amounts of money, largely by looting the 99%.
Yes,
they know
they want
that.
to keep it.
They want to keep it.
They stole it fair and square, damn it.
Yeah. And it's not a done deal that they keep it, right? When the peasants revolt, the aristocracy is threatened. No matter how many soldiers they've got, no matter how big their castles are, there are 99 peasants for every aristocrat. And that makes them inherently dangerous. So the 1% sees this as a very real risk. In other words, an uprising in which, at a minimum, their assets are confiscated. And in the worst case scenario, their lives are threatened. So they're looking for ways out. And I would argue that a currency reset is the simplest way out for them. And historically, that's been the way it's gone. Countries throughout history have ruined their currencies by borrowing too much money and spending too much. And what they've done historically is devalue the currency. In the past, it always happened in the context of sound money. In other words, everybody had gold and silver or some other kind of money that couldn't just be inflated away. So if you, as the Roman Empire, started to inflate away your currency, you had a hyperinflation, but everybody around you had gold and silver and they were okay. Well, this time around it's global. Everybody has fiat currencies. And an inflation that starts with one, especially if it's a major one like the euro or the dollar, affects the whole world. So it's not as immediately clear how you get out of this via a currency reset unless it's coordinated. You know, so it could, instead of just being the on a Sunday night, it could be the European Central Bank, the Bank of Japan, the People's Bank of China, all making the same announcement, adjusted for their domestic currency at the same time. And if that happened, it would be really disruptive for a little while, but we would come out of it in reasonably good shape. And so that's what we should be hoping for, because there is no pain-free option when you borrow too much money. But there are less painful and more painful options, and hopefully we choose the less painful of all the options we have right now, which would be a currency reset.
Which is we have a Federal Reserve note. It's really a debt reset. I mean,
yes, money is an IOU in a fiat currency.
That's
system.
right, and I think Donald Trump's going to revert back to the whole thing. You know, his thinking isn't we're going to print all the money and give you, make you whole as we can. Yeah, some things are just bad investments. I think he's going to give people a haircut. I think some stuff they're just going to let go. I think. Don't you think that? Don't you think it would? I mean, Hillary Clinton would sell Alaska. I mean, I've been saying this about her house. She would give Alaska back to the Russians for 100 ounces of gold. But that's what she would have done. She'd sell Hawaii. No, Obama has a house there. I'm sorry. I'm saying that I think that there's going to be a lot of debt destruction. I don't think the Turks are the only ones going to say, yeah, we can't pay that anymore. Sorry.
Yeah, because when things start to spin out of control, the first thing a lot of people who don't have fiat currencies to play with, or don't have the world's reserve currency to play with, they have to default. They just have to say, well, I'm sorry, I can't pay you back, all right? We can sit down and work out terms, but the terms are going to be me paying you back 1/3 what I borrowed. And that works out when it's done on a fairly small scale. Like if it's one company or one country, you can do that. But when it's 8 countries with a cumulative GDP of a couple of $1 trillion, you're in territory that is, I don't want to say uncharted because the 2008-2009 thing was that big, but it's still really perilous.
The whole thing could blow up, is what you're saying.
Oh, yeah. If a lot of people start defaulting, and then remember, when you default, you stiff your creditors. And then they frequently have to default because they were counting on the money you were going to pay them in order to pay their bills. And so you start a chain reaction. And the reason we have these big bailouts is to stop the chain reaction in its tracks. We've been doing this since the 1990s during the Alan Greenspan tenure at the Fed, where anybody who started to default, the Fed would step in and bail out the banks who would be blown up by that default. So they kept the big banks in business, taught them the lesson that they can take on any amount of risk they want to, any amount of leverage, because the government has their back, and you get today's world. So the question is, in the next batch of bailouts that are apparently coming soon and that will be necessary, can we afford it? Can we bail out $7 or $8 trillion of bad debt again without people figuring it out, without people shorting the currency of the central bank that's doing the bailing out? And, I would say no, but then I would have said no to the last time around. I didn't think we could do what we did starting in 2008, 2009. The idea that we could double the world's debt again was just preposterous. I didn't think it was possible. So I don't think it's possible again. But my track record of knowing what's impossible isn't so good lately. So it's, I guess, conceivable that we could, go from $250 trillion of global debt, including unfunded liabilities, et cetera, and ramp that up to 500 trillion. It's conceivable that we could do that. We can say the numbers and we can write them down. So maybe we can take on that much debt. But it just seems absurd to think that people who own those currencies would put up with it. So
I mean, the
think
whole system could come down this next time. That's what you're saying.
Easily.
I mean, can't the whole system come down?
Oh, yeah. I mean, the whole system, as I said, I thought should have come down in 2008, 2009. So this time around, we really run the risk of dominoes starting to fall, and then us finding out we can't prop them all up because our currencies aren't holding their value as we try to do the propping up. And once that happens, for instance, it doesn't have to be the dollar to begin with. It could be the euro, or it could be the Japanese yen, or even the Chinese yuan. Let one of those currencies start to fall off the table. Then we start looking around and thinking, all right, all that money's flowing into the dollar, looking for a safe haven, but are we any better? Are our numbers any better? Why should we be able to survive something that Japan and China apparently aren't able to do? And at that point, you get the end of the system. The concept of fiat currency and fractional reserve banking and unlimited government deficits, it's just tossed into the trash can of history, as something that didn't work, and we have to go on to something better and newer.
John Rubino, the author of several books, including this one, which is great. I'll put this link up, The Money Bubble. You wrote it with James Turk, incidentally, who's another bright guy. John Rubino of dollarcollapse.com, great site. I've been reading it for years. It just keeps getting better, and you're now writing a lot more stuff on it. I hope your predictions come out correctly. Well, in a way, I hope it does, and I hope they don't. I mean, your predictions for gold and silver. I mean, if people start defaulting, you're going to want to have something they can't print, is what you're saying. You want to have something they can't just, we decided to cut the price of your dollars in half. You can't cut your ounces of gold in half, right?
Yeah, exactly. That's how you protect yourself from something like